So I'm gonna start the class just now, and today we are gonna be focusing on two areas. One is incomplete records, and the next one is bank reconciliation. Right? Please put it in your chat if you understand what incomplete records are. Have you done it in your school or at uni? If you can let me know what. No, okay, fine. Then we will go through it. Just bear with me till I share my screen with you guys. Okay, so I think you can see my screen just now. And basically, incomplete records is a very nice way for your examiner to test your knowledge of the financial transactions, right? And to understand whether kind of get a view of your understanding of the financial records. Now, if I go through the incomplete records questions, right, they will check all these areas. Say, for example, credit sales and receivables, purchasers, establishing purchasers, inventory, cost of sales, all of these areas, they're gonna ask you questions around it. Okay, so the best way of tackling this is going through questions, right? There's no other way to there's no theory so much that I need to explain, but questions are the best way of going through. Now today what I'm gonna be doing is sharing some questions with you and asking you to work it out first, and then we will jump into the answer and I'll walk you through the answer. Okay, and if you can also put in your answer and tell me so what your answer is, that will be good. Now let us go through this. Now what the examiner is giving you is in the questions, he or she will put in some of the statements, and from those statements you will need to find out say for example what the inventory is. The examiner may give you what is the beginning inventory, what are the purchasers, and then he will say, well, the closing inventory is such, and then give me the cost of goods sold. I mean, that's a very easy one that I gave you, right? So the examiner is giving you certain statements and then will ask you to find the answer for some of the things that's not completed, right? Now let us go into the opening statements of financial position, right? Now in this case it is quite easy. They're asking you fixtures and fittings, right? All these transactions are given, and they're asking you to do the business as the following assets and liabilities as at 20x3, and they've given all these things. And then you are required to prepare a statement of financial position for the business, inserting a balancing figure for the proprietor's capital. Now, can you do this for me, please? I'll give you 5 minutes to do this. Okay, so if you can do this in the next 5 minutes, okay, all what you have to do is to put it into the debit side, credit side, and see what is the balancing figure, and that will be the proprietor's capital. Okay, so what is our answer? So have you got this as your answer, right? Fixtures and fittings at cost, proprietor's capital as at 31st, the balancing figure, 13,880, right? Okay, good. So if you've not got 13,880, you should know what went wrong here. Okay, you've got your assets, then you got your accumulated depreciation. You need to take that out. Okay, from the motor vehicles you need to take off your accumulated depreciation. If you do not understand what accumulated depreciation is, please let me know in the chat box. I will explain that to you. And of course you got your current assets, right? And then you will get your the total assets, 19,580. Now when it comes to liabilities, right? Okay, good. Thank you for asking the question. I will answer that very soon. With your current liabilities, there is a gap. Now you know you have got your total assets of 19,580. From 19,580, you deduct the 3,700 and 2,000 to arrive at the proprietor's capital, right? Because that is the balancing figure. Now, accumulated depreciation. What is accumulated depreciation? Let's talk about what is depreciation. You know, if you buy a car, right, a brand new car, as you drive it off from the dealership, it's gonna get depreciated, right? It's called it goes into the second-hand market and it gets depreciated. If every year the value of the car comes down, right? Every year. Now, in accounting terms, your fixed assets, any assets that you owe, right, you will have a certain amount of value, a predetermined value, getting depreciated or reducing in value. Let's say, for example, fixture and fitting might be 10,000, right? Every year there is a value that will get reduced to compensate for depreciation. That is the depreciation for the year, which will get charged to your profit and loss account. And the debit will go into the profit and loss account. The credit will go into the accumulated depreciation account. Okay. Now, what happens is the next year, again, let's say a figure, 1,000 will be charged. I'm just making up a figure. Will get charged a debit to the profit and loss account. Now, the credit will go again to the accumulated depreciation account. What is happening is, in your balance sheet, we need to show the figure, this fixture and fittings at cost. Okay, fixture and fittings at cost, which is 7,000, and then you need to take off the accumulated depreciation. So what is the question? Let's start here again, right? Fixture and fitting at cost, 7,000. Provision for depreciation, fixture and fittings, 4,000. This is what is reflected here, right? Now, provision for depreciation and accumulated depreciation, same thing. Please remember, motor vehicle at cost, they give a 12,000. And we need to reflect that in our balance sheet. And then you have less accumulated depreciation of 6,800. Now, this accumulated depreciation might be coming from a few years, not just that particular year, but it will be a few years before. This is a collection of the depreciation. Hope I've answered the question of what is accumulated depreciation. Is that clear? If it's not clear, I'll go through again. Okay, great. Now, this question, they tested you on proprietor's capital. Okay. Now, this part, now we're going to be looking at I have got a question. I'll come to that. Let me see what the question is. Can the prepayment be assumed for prepaid expenses or prepaid income? Can the prepayment be assumed for prepaid expense or prepaid income? So this is prepayment is prepaid expenses. If you're talking about income, it is called unearned income. Okay, what is unearned income? That means I have received money from a customer, right, in advance for something which I have not, for a sale which I have not actually transacted as yet. Okay, that is called unearned income. Now, credit sales and receivables. What's happened here? Credit sales are payments received from trade receivables, right? Credit sales are, again, payments received from trade receivables plus closing trade receivables, right, less opening balance of trade receivables. Okay, now credit sales are, so this is what credit sales is. So we have got payments received from receivables. Okay, we've got, so we have to get some money from people, right? So what it is we are gonna get this money. We have got this money from these customers. Then we have got closing balance. Now we have a figure at the end, says these, some other people owe X amount of money, right? Then less our opening balance. That will give our credit sales. Now let us put it in your chat box, right? What we're saying simply is, okay, we have got sales, correct? We are selling. Sales would be for cash and credit. Is that clear? There's no other thing, right? Either for cash and for credit, we've got sales. Now, what we have sold before, let's say in the previous month, we have got some closing receivables, right? Everyone has not paid us, right? Let's say everyone has not paid us for that sale, right? So we have some balance remaining that they have to pay us, right? So from that we receive, okay, we receive payments from creditors, right? From these we receive payments from these customers, right? So then what happens afterwards? That part is there. Then we also have sales for this month, right? So this month as well, we have people who've not paid us, right? So that is what is called the closing balance of trade receivables. Okay, so we have got opening balance, which will give you last month's figure. Okay, then we have got payments received, and then we also have got we have got closing balance, right? So we have got three things. We have got opening, we have got closing, and payments received. Now when it comes to opening balance, that is the opening balance from last month. That's why we're reducing it. Okay? That's why we're reducing it. Now you have to remember this, because we're going in for a question. Okay? Let us do this question. A business had trade receivables of 1,750 on 1st of April 20x4 and 3,140 31st March 20x5. If payments received from trade receivables during the year to 31st March were 28,490 and there were no bad debts, calculate the credit sales for the period. Right? So they have given you the opening, the closing, as well as your collection. Right? Let me give you 2 minutes to calculate that. 2 minutes. Yes. So a lot of people are saying it's 29,880. Okay. Quite a few. 29,880. Right. Let's go into the answer. Right. So 29,880 is the answer, because they said cash received, closing plus closing receivables, less opening receivables, and there you go, the credit sales, right? So we're doing small sums, small questions, so that you get an understanding of what is this incomplete records. And the more questions you do, the better it is for you, right? Now, let us do this question. Opening receivables are 6,700. Closing receivables are 3,200 and credit sales for the period is 69,400. What was cash received from receivables during the period? So here we've got the credit sales, we've got the opening, closing, but we don't know the cash received. So what is the cash received? 2 minutes. Here. Put it into your chat box what the cash received is. Right. Let us see how it goes. 72,900. Well, any more answers? Yeah, so many. 65,900. Okay. More going towards 72,900. Yeah. Let us see the answer. Okay. So cash received is 72,900. Right? You can also do this quite easily by opening a T account. Opening balance 6,700, closing balance 3,200. You got sales of 69,400, and here is your cash, the balancing figure. Right? Now you're getting a hang of this incomplete records, I think. Right? Let us go into another question. Right? Since you're doing so well. Opening receivables at 1,500. Closing receivables 1,800. During the year, 45,800 was received from receivables, including 800 in respect of debts written off in an earlier period. Little bit of a twist here. This was never there in our previous examples, right? 3,200 of debts were written off and the allowance for receivables increased by 700. What are the credit sales for the year? This is just trying to trick you with a lot of things here and there. Let us see what you're going to do. Let us see. The question is, what are the credit sales for the year? Okay. Well, I'll give you 2 minutes to decide. Work this out. What do you guys think? So can I have someone working out this problem for me in the chat, please? Right? If you can put out, how you worked out this answer, right? Let me get someone to put it in the chat how they're working out this problem. Okay, 800, 3,000, both are bad debts. Mira's written 42,800. So anyone else? Yeah, go for it. What else do you think? Well, many people saying 42,800, I think. Anyone else? Okay, since 3 people are saying it's 42,800, let's see if that's the answer. Okay. Well, 48,800. How did that happen? Where do you think you went wrong? Where do you think you went wrong? Well, because 45,800 is given. Bad debt expenses 3,000. Yes, exactly. Right. So the bad debt expense is 3,200. So what really took place here? Let's see. So we were all right. We were going swimmingly fine, up till till this bad debt story came about. Because including what this saying is, from receivable, 45,800 was received from receivables, including 800 in respect of debts written off in an earlier period, right? So 45,800, right? 45,800. So what did they do? Is the 800 taken into consideration? No, right? They have not taken that. Now, and then in respect of debt written off in an earlier period, 3,200 of debts were written off and the allowance for receivable increased by 700. Now, in this case, I did not take here that 800, but I have included 3,200, right, as the bad debts written off. Correct? Why didn't we take 800? Yes, someone's asking why didn't we take 800? Because it was received against a bad debt that was written off in an earlier period, not in this period. Okay, it was in an earlier period, so we will not take it into consideration when we are working out this sales for the year, right? Credit sales for the year. Okay, that is the reason. Now, similar story we are talking about. Are you guys enjoying this questions and answer session now? Right? Good. Right, why didn't we take 700? Now, hang on for a second. Where's this 700? Can anybody explain why we didn't take this 700? put it into the chat. Tell your colleague why we did not take this 700. Any reason? Let's say if we got some teachers out there. Yeah, why didn't we? It's admin expense. Well, what do you think? Why didn't we take this 700? You need to explain it. Was it written off? Now, what we're saying is the increase in put in profit and loss. Now, question, what is the question asked? What are the credit sales for the year? So don't get confused, right? Do not get confused. What are the credit sales for the period? For the credit sales, what should you take into account? Opening receivables, closing receivables, money received, okay? And anything that was written off, okay? The write-off of bad debts. So the 4 things that we take into consideration: opening, closing, cash received, plus any write-offs that we are allocating. Only these things that we will take when we are calculating the credit sales, right? Only these things that we would take, nothing else, right? This 800 is a bit of noise that the examiner has put in so that we will get confused and include that, right? And we only take off the money that's given, where they say we've received money. We will only take the funds that is for this financial year, right? Not anything that was for a previous period, okay? And receive there again, this is a bit of noise. Receivable increased by 700. So what? It doesn't mean nothing to us, right? It does not come into the picture if you're going to calculate the credit sales, right? Is that clear? Is that clear? Yeah, brilliant. Now we are going to do a similar thing, right? We're doing a similar thing for purchases and trade payables. Now you guys would be masters because we've gone through one round that was related to sales and receivables. Now we're going to do purchases and trade payables. Identical concept, identical. Payments to trade payables during the period, closing, opening, and then you have the purchases during the period, okay? Now let us do this example. I'll give you 2 minutes to work this out. So trade payables at the beginning, trade payables at the end, right? And what was purchases during the year? What do you think? Let's put it in the chat. Okay. Okay, Alan, thank you. Oma, yeah, thank you. Let's see. Yeah, very quick, I must say. You guys are very quick. Wow, fine. I'm getting lots of answers. Lots of answers. Right. Okay, let us go. Let us go to the answer. 30,396, right? So just a lot of you guys have said 30,396, but some have said 30,666,393. I'm just wondering whether it's a typo, right? You guys accidentally made a mistake when calculating. So payments to trade payables was 31,000 plus closing balance less opening balance to get to the purchases. Okay, any questions here so far? If there's any question, let me know. Otherwise, let's go to the next one. Right now, establishing purchases. Yes, correct. Credit purchases. Establishing purchases, inventories, or cost of sales. Now we're going to bring a little bit of twists here. We're talking about inventories, cost of goods sold. You will have returns, all these kind of good things coming to play, right? Now let's see. Let us go into this question. Inventory of a business. 1st July was 8,400. Inventory count at the end was showed in inventory to be 9,350. Sales for the year was 80,000. Cost of goods sold was 60,000. What were the purchases during the year? So we have got the inventory beginning, end, cost of goods sold, and they're asking the purchases for the period. Okay then, let's see. Let's see who's gonna start off today. Okay, Alan, very quick. Mirza, that's good. Okay, anyone else? Let's see the answer. Okay, 60,950. Yeah, you guys are correct. Okay, so 60,950 is the answer. I think you guys are pretty good because you're getting a very good hang of this incomplete records. And now using gross profit margin and markup to find figures in the trading account. Now they're making a bit more complex for you because you were doing so well so far. Now we're trying to bring in gross profit margin and the markup. Okay. Now you need to remember these terms. The margin is gross profit divided by sales is the gross profit margin. A markup is the gross profit divided by cost of goods sold. So basically say it's marked up by 20%. That means from the gross profit it's increased by 20%. Okay. Margin is basically on sales. So remember, a margin means it's the gross profit, it's on sales. If it's a markup, that means it's on the cost of goods sold. Okay, let's see. Sales are $1,000 and the cost of goods sold is $600. What are the profit margin and markup for this? Okay, what is the profit margin and what is the markup? Let's see. Alan, very good. Who else? I wonder who can beat Alan. He's always pretty fast. Yeah. Profit margin. Okay. Right. Yeah. Okay. Let us see now. What is our profit margin? And yeah, I think you guys are right. So this is relatively a simple question to explain what is a gross profit margin and the markup. Okay, now let's do this one. At 1st May 20x3, inventory was 4,000. At 30th April, it was 3,000. Sales for the year was 80, and the business always has a markup of 33.13%. What were the purchases for the year? Okay, what were the purchases for the year? What do you guys think? So if I look at my calculation, markup means so let's go back. Well, what do you guys think? Very quiet. Alan, what do you think? Trying to figure it out. Yeah, okay. Anyone else? Anyone else? Okay, let me not give you a hard time. Let's go to the answer. Working backwards. That's what happened here, right? Now, Miraz, 59,000. Okay, so here you go. We have to work backwards in this case, right? For the year, the sales was 80,000. Gross profit was 20. So this used to confuse me a lot when I used to study as well, to be honest, because working backwards is quite difficult, right? And so the thing is, this 80,000 is actually the 133.13, right? Now, when you look at this markup, you think, oh, now they're talking about gross profit and cost of goods sold, right? Now, where is this sales thing coming up? The sales thing is not there at all. But actually, the sales means it's marked up, right? It's marked up by, it becomes 133.13%. The reason is, if you look at, this is gross profit over cost of goods sold. The markup is on that, right? Cost of goods sold. 33. So we need to add this 33%, right? And then you work it backwards, what the purchases was, right? Is that clear? Right? They like this kind of questions. Can we convert the markup? 1 second. What the question is, can we convert the markup to the gross profit margin? Can we convert the markup to the gross profit? Basically, you know, the easiest way to work these questions is you understanding, well, what is 80, how is 80,000 and how is this markup linked to it, right? Because it's a very easy way to work backwards thereafter. Okay. Now, if they had given you just the gross profit and cost of goods sold and asked you to given you, calculate the markup, that's a different story. That's a very easy one. Or even if they're given the markup and the cost of goods sold and told you to calculate the gross profit, it's easy, right? These three combinations is very easy. Only the problem comes if you're given that the sales figure, right? Suddenly it throws you out and you send, what am I going to calculate, right? Okay. Now, let us go into the next one. Now, again, we are coming into a inventory situation, right? With stolen goods or goods destroyed. Okay. In this case, let's look at this. All in Flames is a shop which sells fashion clothes. On 1st 20x5, it had inventory which costed 7,345. During 9 months to 30th September 20x5, the business purchased goods from suppliers costing 106,000. Okay, sales during the same period was 154,000. The shop makes a gross profit of 40% on cost or markup for everything it sells. On 30th September, there was a fire in the shop, right? That's why they've given these figures up till 30th September, which destroyed most of the inventory in it. Only a small amount of inventory known to have costed 350 was undamaged and still fit for sale. How much inventory was lost in the fire? Let's work this out. Right. So there is opening inventory, purchases, sales, and there is a cost of goods sold there which you need to take out. Okay. And then you have the closing closing stock, okay, which is 350. What do you guys think? Let's work it out fast. Let's see who's going to give me the answer first. Wow, Alan again. Well, someone else? What do you guys think? Let's go for it. I want someone else to give me an answer as well. Well, Miraz, what about you? Anyone else? Miraz has given 3,415 and okay, let us say okay, so anyone else who can probably take us through this question and tell us how they worked out the answer? Okay, so how much is the cost of goods sold? What is the cost of goods sold, guys, in this case? Okay, right. So cost of goods sold is 110,000, right? And then we are going to work out our how much was lost. Okay, opening inventory at cost, right? Then plus purchases less closing inventory equals to cost of goods sold and goods lost. Okay, then we have got our total goods lost and sold, a figure, minus the cost of goods sold of 110,000, which we know, we worked out right at the beginning how much it was, right? And therefore we've got the goods lost. So again, you have to do it quite systematically, right? You work out your cost of goods, you know your sales. So then from there you have to work out what is the cost of goods sold. And because they're also saying the gross profit 40% on cost, a markup of 40%, right? So 40% markup means from your cost of goods sold a 40% markup. That is 40% of 110, yeah, is 44,000, and then 154 is your sales. Okay, is that clear to everybody? Right. Now I have to do some of the another topic today, which is the bank reconciliation, right? Now, right, I will do the transactions, the accounting related to this, and then what I will do is close this chapter for today, right? I'll put up some questions as well, and then we will look into our bank reconciliation. So I think I have a question there from Lubna. Lubna, what did you mean with a question mark? Tell me. If you can chat, if you can tell me what is the question that you're asking. Okay, Lubna is asking, how did you get the 110,000? Right. So how did we get the 110,000 is nothing but we have been told, right, sales during the same period was 154,000. So this sales figure is given, okay? And also they say the shop makes a gross profit of 40% on cost. Right? Now what is 40% on cost? Remember this? Right? Remember this? A markup? 40% they're making. So then you're saying this is given. You arrive at 110. Right? Is that clear? Okay, great. Now let us go into our accounting entries. What is happening? If the lost goods are not insured, that is a terrible situation, the business must bear the loss, and the loss is shown in the income statement. Fair enough, right? So income statement, it's an expense, and the trading account, it's a credit. Okay, so in the income statement, it's an expense. If the lost goods were insured, which is fantastic, the business will not suffer a loss because the insurance will pay back the cost of the lost goods, right? Therefore, in this case, insurance claim account is a receivable account. They'll get debited. Okay, it's as if somebody has to pay us, so it's a debit. And again, the trading account is credited. Now, with the cost of the loss, the insurance claim will then be a current asset. That's clear, isn't it? Because they have to pay us. When the claim is paid, the account is then closed by debit cash, credit insurance claim account. Okay, because we are receiving the cash and then the insurance claim account gets credited. It's similar to exactly the same entries as if when a debtor has to pay us. Is that clear? Right. Any questions in these accounting entries? Right. Any questions? Right. Now, let us repeat. When inventory is stolen, destroyed, lost. Okay. If inventory is stolen, destroyed, or lost, we have to record it somewhere, right? And there are two options here. Either the company has insured or not insured. If the company is insured, fantastic, right? That means the company is going to get the money back, right? So in this case, I will look at this B option. I'm creating the entry saying debit insurance claim account because somebody has to pay us. Okay, it will get reflected in our receivable account, okay, as a current asset. And if the debit is insurance claim account, credit will go into the trading account. Okay, credit goes into the trading account. Now in this case, when the insurance claim is paid off by the insurance company, we're going to get money, correct? So at that point, debit cash and your insurance claim account will get settled off and credit that. Okay, so then insurance claim account closes. However, if unfortunately the company has not insured, the income statement will have to get debited as an expense of this goods stolen, lost, or destroyed, and credit the trading account. Is that clear? Can there be a partial claim? Of course, yes. It is very possible, right? And it happens. If it is a partial claim, what would be the entry, Alan? What would be the entry if it's a partial claim? We will have a component going into the debit portion of it will going into the income statement expense, and a portion will go into the insurance claim account. Right? Is that clear? So let's say, for example, 60% insurance is giving us. So 60% will be debited to insurance claim account, and 40% debited to income statement expense account. Correct? Is that clear for you guys? Yep. All right then. Right, let us try to do this question, the last question, before we go into our bank reconciliation. Right, let me give you 5 minutes to do this. Okay, so let's start. We are looking at on 1st January. We've got inventory at cost 4,700, and his trade payables was 3,950. Right? We have got a sales situation with the gross profit of 33.13 on the sales value. That is the margin of everything he sells. Right? he makes a gross profit of 33.13 on the sales value. So this means you can very quickly calculate from the sales, right, the the cost of goods sold, right? On 30th June, there was a burglary at the shop and all the inventory was stolen. In trying to establish how much inventory had been taken, Bill was only able to say that he knew from his bank statement that he had paid $28,400 to payables, right? He currently owned payable $5,550. So we have beginning payables as well, right? Now here we have got closing payables, right? And an amount he has paid. But then we have to understand how much is purchased, okay? And let us now calculate. Now let us see how they calculated it. So we first work out the payables. We have an opening balance, right? We have a closing balance. Payments to payables is there, right? Now have they given that to us? Yes. We've got closing balance, we've got an opening balance 3,950. Now this is a balancing figure, okay? This is a balancing figure. Now when we look at cost of goods sold is also unknown, but this can be established from the gross profit margin. We spoke about that, right? Now cost of goods sold was 28,000, right? That is very clear. We can work that out. The cost of goods stolen is how much? We have the opening inventory, we have the purchases, less cost of goods sold and goods stolen, we know that, right? And cost of goods sold is 28,000. We know that because after we calculate from the sales, the gross profit, we know it is 28,000. Therefore, the cost of goods stolen is 6,700. So did you guys get this? Yes, Alan? Yeah. Very good. Anyone else who's confused about this? Right. First, what we're going to do is calculate and do it in stages, right? When you look at this sum, you see a lot of things happening, right? You see a lot of words, a lot of numbers, you get confused. It is very normal. So what are they asking? Calculate the amount of inventory stolen. Prepare a trading account for 6 months. Okay? Now, the first thing is that we can work out the payables, because for inventory stolen, we need this, right? If we have to calculate this inventory stolen, we need this payables figure as well, because we need the purchases. So what do? We work out these payables. Now, opening balance brought forward is given in the sum. Closing balance brought forward is also given in the sum. Right. Closing balance carried forward is given. Let's say you get this one, right? Now 5550 and 3950. So 3950 is given in the sum, and 5550 is also given in the sum. Okay? Then we say, well, payments to payable is also given in the sum. Therefore, purchases is merely a balancing figure. Right? Is that clear? Yeah? Good. Now we tackle the next part, because we first tackled the easy part. Now we tackle the next bit difficult part, which is the gross profit margin. Now they say in the sum, okay, the sales was 42,000. Bill makes a gross profit of 33% on the sales value. Alright? He makes 33.13% on the sales value. What does this mean? Sales is 100. Gross profit is 33.13%. Okay? And therefore, the cost of goods sold is 28,000. Is that clear? So, one of the things that used to really bother me and really used to confuse the hell out of me is in one time you can quite easily understand this one, right? When it says sales is 100, gross profit 33.13. Now let's look at the previous one. If you remember, right? If you remember, sales is 140%, right? This used to really bother me, right? But remember, here the wording is different. The shop makes a gross profit of 40% on cost. Okay? So in this case, the cost of goods sold is 100 and then the gross profit is 40. In my current sum, my sales is 100. So be careful, okay? Be really careful. This is quite confusing to students, okay? Really confusing. So is this fine? How we worked out the 28,000? So once, yeah, it's just the wording. Be very careful. I will have this as sums in your notes, because it will make things a bit easy for you, because when you look at it over and over again, it's easy, right? Now, in this case, we worked out my purchases. Now I worked out my cost of goods sold. Now next is I'm gonna work out my cost of goods stolen, right? So we have to do like A, B, C only at the third section that we're really getting into this sum. So what is the opening inventory? It's given. Purchases we've just worked out. Okay, so its total is 34,700. Now 34,700 comprises, okay, of cost of goods sold and goods stolen. Now then from there we're going to take out 28,000, which is nothing but our cost of goods sold, which was worked out before, and thereafter we get this 6,700. Now there is a question for me. Let me see. What is the difference between markup and sales margin? Good question. Anyone who wants to take a stab at it? Anyone? What is the difference between cost markup and sales margin? Right? And that's the thing that really bothers people as well. Now, in this cost markup, now let us look at this. Here, they're talking about a margin, right? A margin. The previous sum, they're talking about a cost markup. Cost is cost of goods sold. Exactly. Margin is on sales. Cost of goods sold, which is 100, 110, and then a markup of 40. Okay, is that clear? And in this margin is on your sales. Okay, so that's why you're saying gross profit margin. So your sales at that point becomes 100, and thereafter you work out your gross profit. Yeah, is that clear? Okay. Markup is on cost of goods sold. Yeah, margin is on sale. Yeah, correct. So Kartika, is that clear for you? Right. Now on that we are going to complete today's session on this particular topic, and I'm going into bank reconciliation. Okay, I will give you some questions on this cash book. We have some questions there. One second, let me see what other interesting stuff is there for you. By the way, are you guys familiar with bank reconciliation and how to do bank reconciliations? Mera says no. Anyone else? I did it 4 years ago. Okay, only a few of us. Fine. Right, okay. Okay, fine. I think we will go into bank reconciliations from the responses that I'm getting. Accruals and prepayments. Very quickly, what is accrual? What is prepayments? What do you guys know about that? I'm just looking to see what other problems are there here. Yeah. So basically, what we call, let me talk about accruals, right? Now, let me be in one place and talk and without confusing everybody. Let me go into this accrual sum. Right. So accruals means that we have to pay an amount. Let's say an example would be, I have to pay rent for this month for this particular building, and I have not paid for it. But of course, I know it's 100%. I know that I have to pay for it. It's an expense for the month, right? Beyond any doubt, it's an amount that I have to pay, and I will basically account for this in my accounts. And can someone tell me what are the accounting entries for this? What would you debit and what would you credit? Okay, rent. I'm talking about rent. I have to pay this amount, and I have not paid for it, but I need to account for it in the books. Where will I debit? And yeah, that's correct. And the credit, Anjali, where would I credit? Anyone else? Anyone else? Let's start. Is it debit rent expense? Correct. Credit where? Correct. And yes, and will it be and is it a balance sheet, the credit side of it? Is it a balance sheet item or is it a profit and loss item? If it's, and tell me where will it get where will it get categorized? Right? Is it a balance sheet because it's a liability? Correct, Alan, you're right. And there it is a credit item in the balance sheet, and it will be current liability. Correct. The debit side, okay, the debit side will be a profit and loss, and that is rent, profit and loss. Okay, so that's how the entry is. Now prepayment is where we have paid in advance. Rent we have paid 12 months in advance. Okay, so the prepayment, where will it be? Where would the debit go? Where would the credit go? It is rental again. So the scenario is rental, prepayment. Debit would be balance sheet asset. Correct. So what it'll be, correct. So there will be a rent for the month which is debited to P&L. Correct, it will go into the P&L. Then you will have the rent prepayment balance sheet. Correct, and it will be, where would it go? Current assets. Yeah, and of course the credit will be in the bank or cash. Okay, so now you can see how these accruals and prepayments will work. Okay, so I want to rush into this my bank reconciliation topic. Okay, I will cover this area. If there is, now I've covered quite a bit in this area. I will have some notes as well and questions, answers. If you're not clear, please put the questions to me on the Facebook, right? You guys have a Facebook group. Please post the questions there so that any one of our lecturers will jump in and answer. Okay? Right. Now I'm gonna stop sharing my screen with you for a second till I go into the balance sheet, into the bank reconciliation. Let me go. Right. Okay, I'm gonna share my screen with you and show you the bank reconciliation. Right. Now, let us figure one thing out. Okay. Now, tell me guys, how do you get money into your bank account? Right. How do you get money into this bank account? Right. Yes, you can go and deposit. What else? There are a couple of other ways that you can get money into your bank account. Transfer, very good. And what else? A bit of a traditional way of doing things. What do you think? You know, when they still, where people write interest earned, yes, very good. And what else? And what else? Someone has to write something and give it to someone else. You call it bills of exchange, check. Exactly, right? Now we say that when, credit notes. So there are some ways of bank transfers. you immediately get money, right? Instantly. If I want to transfer money to you, I use certain methods, and you get the money instantly, right? And mostly, if both of us have an account in the same bank and I want to transfer it, it happens automatically, isn't it? But there are other ways, some other situations when the money is transferred, I do not get it to my account, or the other person does not get to that they don't get the money immediately, right? Now, this is the problem. This is really a problem, and this is the reason why we carry out bank reconciliations. Now, the thing is, with companies that has hundreds and hundreds of transactions, payments, this becomes a nightmare. Okay, becomes a nightmare. And actually, what we use a lot of electronic formats to do the reconciliation as well. So in real life, what happens here is, you would have seen the bank statement. I mean, individuals get the bank statement either paper format, or they can go to the bank portal, have a look at their statement, can see what is appearing as debits and credits. Yeah. And then we also look at in a company situation, the company gets statements sent by the bank electronically every day. Okay, because there are so many transactions, what they do is they send it every day, right? Every day to a place, electronically it's sent, so that the company is able to then check with their accounting system and then do the reconciliation automatically. Right? They try to do the reconciliation automatically and then see what are the transactions that have got matched and what are the transactions that are not matched. Okay, so what are the transactions that why do you think that there would be certain things that will not get matched, right? What sort of things will create this unmatched situation? So can you guys tell me what could be the reason for these unmatched situations? Give me some examples. Yes, errors, wrong amounts, correct. And in this book, it's written bank charges or bank interest. How does that create an unreconciled situation? How does that create an unreconciled situation? Can you tell me? Any idea? Let's see. Now, what happens there is, from the bank side, bank creates this charge or gives us an interest. So the entry is recorded or initiated at the bank side. Okay? So the bank is initiating that entry. We in the company don't know about it. Okay? So now when it comes in to they send the bank statement, and we try to reconcile. Reconcile is basically, checking whether what is in the bank is in our accounting system. If it is not there, we say there is a issue here, unreconciled item. Then we check what is this unreconciled item, right? It would be a bank charge. or a bank interest. Okay, because since the bank has created or initiated it, we didn't know about this entry. Now we need to create it in our books. Okay, what is timing difference? Timing difference is nothing but where I have made a payment to you, right? And in my I'm supposed to get a payment. Okay, I'm supposed to get a payment. So I'm recording it as if I'm going to get this payment, but actually it has not appeared, or I have recorded, I've got a check from you, I've said, well, I have received this payment, I've recorded it, the check I received physically, but I did not receive the money in the bank because it takes time for the bank to clear it, right? Hence the timing difference. Okay, and there could be errors as well, right? Errors made by us, okay, more than the bank. So it is we making errors, and we'll see them, and it doesn't, of course, get thrown out in the reconciliation. Okay, now what do you guys think? Is the bank reconciliation necessary? It is. It is actually a very, very important control, an internal control. I have experienced in a company where they had not carried out a proper bank reconciliation, and due to that there was a fraud that was there was a fraud. They did not detect this fraud for about 15 years. Okay, because they had not carried out a proper bank reconciliation. Okay, and the reason is, especially when you have post dated checks. Do you understand what post dated check means? Yes? Okay. Post dated check means it is a check where I give you a check, but it is dated, right? It is dated for 2 months from now. So correct. And what happened in this case where the fraud occurred is where the account person was given a lot of post-dated checks, and this person was collecting them. And when this person who gave the check, he comes and says, actually this is a rental company, a real estate company, and then this tenant comes and says, well, can I take my check back? I'll give you cash, right? And this accounts person accepts this cash, returns the check to this person, the tenant, but instead of depositing the cash, what he does is he will put in another check of his and takes the money, right? So this is kind of, he was using this cash as a stopgap, and he was doing all kinds of things, but really didn't get caught properly. And it went on for about 15 years, and it was a really bad situation. So it is an important, very important check, very important tool. Okay, so let us see if I can get some questions for you, right? Now, one of the things, unpresented checks are checks sent out which do not yet appear on the statement, right? So it could be I have made payments, okay? I have made payments to someone. It's not a bank transfer. I have made a payment via check, and it is not appearing in the bank statement. So we call it unpresented checks. Similarly, uncleared lodgements of checks received and paid, right? So the thing is, in this case, where we are dealing with checks, this is where there is a delay, okay? there is a delay when it comes to checks, right? Even at times when we are transferring, even if it's a bank transfer, when it's an overseas bank transfer, it does take some time. From our side, I will transfer the amount to the other party, but that party will not get it till 3-4 days, right? So from my side, as if I'm showing it's the payment's gone. Okay, now example of bank reconciliation. The cash book balance is so much, a bank statement shows a balance of so much, right? Required, show the correction to the cash book, prepare a statement reconciling the bank statement and the cash book balance. I'll give you 5 minutes for you to do this. Okay, let's attempt this. And see what we have to do, because first thing is, right, how. Okay, as at 30th September, let's work this out together then. Okay, as at 30th September 2026, the cash book balance is 805, a debit. A bank statement on the 30th September shows a balance of 1112.30. So obviously there is a difference. Okay, there is a difference. On investigation of the difference between the two sums, the following points arise. The cash book had been undercast by 90 on the debit side, right? Casting is an accountant's term for adding up, right? They have not added up properly. Checks paid in, not yet credited by the bank, amounted to 208, right? So in your bank balance, right, of 1112.30, there is 208.20 which is actually not got realized, right? That means there has to be an addition. Checks drawn not yet presented to the bank amounted to 425.35. Now our cash book is 805.15. We have to add correction of undercasting, because a 90, it should be 895.15. Okay, then balance as per bank statement was so much. It is given. Uncleared lodgements, that means it has not got cleared. Actually this is a collection, right? We need to add it to this, and we need to deduct 425.35, because again this amount we have actually given the checks, but it has not gone out of our bank account. So there is a 425.35 minus 208.20 amounts to 217.15, which is a negative. And if I take the total balance, it becomes 895.15. Now you can see how both the cash book and your bank balances. Okay, is that clear? Yeah, is that clear for you guys? Right, so first we came up with a bank balance, a cash book balance of 805.15, and then the bank balance was 1112.30. Okay, immediately we saw there is a difference, but there were 3 transactions that was causing this difference. One went into the cash book, we added it, and then we said okay, now it's 895.15. Now we look at our bank balance, which is 1112.30. From there I need to get a summary of this, right? which is a negative 217.15, and I arrive at the 895.15. Is that clear? Right? Any explanation? Miraz, are you clear with it? Okay, fine. Now let us do a sum together again. Which of the following statements are true? Okay, let us do this. True or false, right? Which two of the following statements are true? Okay, which two are true? Unpresented checks should be treated as a timing difference. Unpresented checks should be written back into the cash book. Uncleared lodgements reduce the figure per bank statement. Uncleared lodgements increase the figures per bank statement. So you need to know the difference between unpresented checks, uncleared lodgements. Okay. I'm going to take you here. Unpresented checks are checks sent out which do not yet appear on the bank statement. Checks sent out which do not yet appear in the bank statement. Uncleared lodgements are checks received and paid into the bank which do not yet appear in the statement. Okay. Correct. 1 and 4 are correct. Okay. Now, let us do this. Oh, wow. Okay. Let us finish off today with this quite a long sum. Okay. Are you guys up to do this? Right. Let's attempt. I'll give you 5 minutes. Yeah, go for it. So one of the things that you have to remember is when you're reconciling something, you're reconciling two things, right? So that's what first thing you need to remember. That's a cash book and your bank statement. Okay. So in this case, your cash started with an overdraft, right? That means you actually do not have money, right? As per my cash book, it's a negative 300. Okay? But in the bank, it shows as if they have got a positive 65. That's where our starting point. So you need to take 2 pages and say one is your cash, one is your bank, right? And then start out the transaction, right? Now on checking the cash book with the bank statement, you find the following: checks drawn of 500 entered in the cash book but not yet presented. Okay, what's happened there? First transaction. So in your bank statement, how should it appear? How should it appear? Remember, checks not presented, and you had 2 things: unpresented checks, uncleared lodgements. Okay. So checks drawn of 500 entered in the cash book but not yet presented. So you need to tell me where will it appear. Then the next one, checks received of 400 entered in the cash book but not yet credited by the bank. Okay. So where would that come in? What do you think? What do you think? What is the unpresented amount here? Right? What is the unpresented amount? Now let's go into the answer. Right? So each one, so adjustment in the cash book, debit and credit. Okay, so each one we need to go on doing, right? Now in this case, what are we doing? Cash books incorrectly credited with interest on 30th June, right? There can be quite a few questions actually on this. It is an easy one once you kind of get the gist of it. Okay, we're just going through the first two sums, so you may find it a bit confusing, but it is really not all that. Now if I look at this, okay, solution, adjustment in the cash book. Cash book incorrectly credited with interest on 30th June should have been debited with the receipt. Okay, so we enter that. Debit cash book current account with the transfer of interest deposit. Okay, bank charges, because they're saying if we go bank charges 35 in the bank statement had not been entered in the cash book, so you need to enter that, right? The previous transaction was the bank has transferred interest received on deposit account of 60 to current account, recording the transfers on the 5th of July. This amount had been credited in the cash book as on 30th June, right? There's some mistake that has happened. Okay, so on the 5th, but actually they have taken it on the 30th, right? The payment side of the cash book has been undercast by 10. Remember, we had a similar situation before. So undercast the payment side, we need to add it. Dividends received should be debited in the cash book. I have got money, right? 200. Checks drawn on deposit account, not current account, right? So what has happened here is a check of 50 drawn on deposit account had been shown in the cash book as drawn on current account, so it's in the wrong account. Okay, so that needs to get corrected here. Add, right? So you need to add back. Okay, even this, if you remember this 60, we are adding back. And then checks paid to Jones is out of date and so cancelled. The cash book should now be debited because I'm adding back that 25 because actually the money did not go out because it was the date was not right, so it didn't, the money, they couldn't encash this check, right? So this is what happened here. Okay, now what happened here? Now cash book balance on current account as of 30th June was 300. These are the adjustment. Corrected balance in the cash book should be 50, right? So we started, right? I will send this question to you separately. Okay, so how did we start off? When we started off this example, we said it was 300, right? A 300 overdraft, but in the bank there was a credit of 65. Okay, but when we calculated all this, we have the corrected balance in the cash book as 50. This is quite a lengthy, very lengthy sum. Okay, now we are actually going to reconcile my bank as well. Okay, so remember those checks before? Outstanding lodgement checks, checks paid but not yet credited 400, I need to add them back. Deposit interest not yet credited 60, so both I add them back 525. Then less checks, then we need to cancel that 25 a check for $25, and then we end up with a 50. So now both balance, right? What I'm going to do is include this big sum in your Dropbox so that you can practice it, right? In your exam you will not get such lengthy sums, but this one kind of covers a lot. Okay. Now somebody has asked my email address, so I would encourage you to best write to this email address. Okay, and also join us on our Facebook page and put up any questions that you want, right? I will give you more questions related to the bank reconciliations. I think again, the more you do it, okay, I'm gonna put the Facebook page name. I'm gonna stop sharing just now and go into the Facebook page and give you that. Okay, the more you start doing the questions, the better it is for you. So it is best that I give you more questions and you come back to me if you do not understand them. Okay, so hang on for a second. Let me give you this Facebook. So how's the class so far? How's the bank reconciliation going? Did you understand? Where can I find the past class videos? Yeah, it's on the YouTube, right? It is posted in the Facebook group as well, where the videos are. Okay. Yeah, YouTube link, that's correct. We have to upload more. Yes, this bank reconciliation, I just couldn't figure this out myself. You know, it becomes really easy when you start doing it in practice, and thankfully a lot of it is done electronically these days, so you don't have to bother so much. But fundamentals, it's important you understand the fundamentals, right? Then things will become very much easy. Try to kind of get your parents' bank statements if they allow you to touch them, right? And try to see how you can reconcile them, right? If you get a chance to work in another, if you're working as an intern in a company or something like that, again, try your best to lay your hands in some of the bank reconciliations, actual things, what they do. Yes, some practice definitely would help, and it's not as daunting in reality as it is in a theoretical sense. I assure you this, because I used to have nightmares with this myself. All right. Good night, guys. Hope you had a good class. I'm taking tomorrow's class as well, right? Kumar has gone globetrotting for a couple of days, so you should ask him when he comes back what he's been up to. All right, and let's touch base tomorrow. Good night.